What is business and finance? Do not you remember, you already have learnt in previous chapters. An organization or economic system where goods and services are exchanged for one another or for money is called business. While the management of large amounts of money, especially by governments or large companies, is called finance. Why do business need finance? Often called capital, businesses need finance to start up a business, expand an existing business, increase working capital, finance needed by business to pay its day-to-day costs, selling debentures. These are long-term loan certificates issued by limited companies. Advantages: debentures can be used to raise very long-term finance, example 50 years. Disadvantages: must be repaid and interest must be paid. Long-term loans or debt finance. Loans differ from share capital in the following ways. Loan interest is paid before tax and is an expense. Loan interest must be paid every year, but dividends do not have to be paid if, example, the firm has made a loss. Loans must be repaid, as they are not permanent capital. Loans are often secured against particular assets. Leasing allows the firm to use an asset, but it does not have to purchase it. Monthly leasing payments are made. Advantages of leasing: the firm does not have to have a huge amount of money to purchase the asset to start with. The care and maintenance of the asset are carried out by the leasing company. Disadvantages of leasing: the total cost of the leasing charges will be higher than purchasing the asset. Higher purchases allows a business to buy a fixed asset over a long period of time with monthly payments which include an interest charge. Advantages: the firm does not have to find a large cash of sum to purchase the asset. Disadvantages: a cash deposit is paid at the start of the period. Interest payments can be quite high. Finance which is available for more than a year and sometimes for many years. Money usually used to purchase long-term fixed assets, update or expand the business, take over. Main sources are hire purchase, leasing, bank loans, long-term loans or debt finance, debentures, sale, issuing of shares, trade credit. This is when a business delays paying its suppliers, which leaves the business in a better cash position. Advantages of trade credit: interest-free loan to the business for the length of time the payment is delayed for. Disadvantages of trade credit: the supplier might refuse to give discounts or even refuse to supply goods if payment is not made quickly. Overdraft: these are arranged by a bank. Advantages of overdraft: permission from your bank to go overdrawn in your bank account, spend more money than is currently in the account. This finance can be used for wages or to pay suppliers. Flexible form of borrowing. Interest is only paid on the amount overdrawn. Cheaper than loans. Disadvantages of overdraft: interest rates are variable. The bank can ask for the amount overdrawn to be paid back at a short notice. Short-term financing refers to business or personal loans that have a shorter than average time span for repaying the loan, typically 1 year or less. Microfinance. Providing financial services, including small loans to poor people not served by traditional banks. Banks didn't lend because the size of the loans required by poor customers, perhaps a few dollars, meant the bank couldn't make a profit from the loans. The poorer groups in society often have no asset to act as security for loans. Banks are usually not prepared to take risks by lending without some form of security, assets they can sell if the borrower cannot pay. Grants and subsidies from outside agencies. Outside agencies include, example, the government. Advantages: grants and subsidies usually do not have to be repaid. Disadvantages: they are often with strings attached. Example, the firm must locate in a particular area. Factoring of debts. Buying the debt of a firm. Debtor is a customer who owes a firm money for goods bought. Debt factors are specialist agencies that buy the claims on debtors of firms for instant cash. Example: debt factor may offer 90% of an existing debt. Debtor will then pay the factor and the 10% represents the factor's profit, when the factor collects payment from the debtor. Advantages: immediate cash is made available to the business. The risk of collecting the debt becomes the factor's and not the business's. Disadvantages: firm does not receive 100% of value of its debt. Bank loans. A sum of money obtained from a bank which must be repaid and on which interest is payable. Advantages: quick to arrange. Can be for varying lengths of time. Large companies are often offered low rates of interest if they borrow a large amount of money. Disadvantages: has to be repaid eventually plus the added interest. Security or collateral is often required. Financial needs of business. Revenue expenditure. Capital expenditure. Startup capital. Capital to expand the business. Capital to support a business in difficulty. Issue of shares. This source is only possible for companies, private limited, limited, and public limited, PLC, companies. Advantages: permanent source of capital which would not have to be repaid to the shareholders. No interest has to be paid. Disadvantages: dividends are paid after tax, whereas interest on loans is paid before tax is deducted. Dividends will be expected by shareholders. Ownership of the company could change hands if many shares are sold. External sources of finances. Obtained from sources outside and separate from the business. Owner's savings. A sole trader or members of a partnership can put more of their savings into their unincorporated businesses. Owners of these firms are not separate from their businesses, so finance is called internal. Advantages: it should be available to the firm quickly, no interest is paid. Disadvantages: savings may be too low, it increases the risk taken by the owners. Sale of inventories to reduce inventory levels. This reduces the opportunity cost and storage cost of high inventory levels. But it must be done carefully to avoid disappointing customers if not enough goods are kept as inventory. Sale of existing assets. Existing assets that could be sold are those items of value which are no longer required by the business, example redundant buildings or surplus equipment. Advantages: better use of the capital tied up in the business. Disadvantages: take some time to sell the assets. It must be done carefully to avoid disappointed customers if not enough goods are kept in stock. Retained profit. This is profit kept in the business after the owners have taken their share of the profits. It is often called plowback profit. Advantages: does not have to be repaid. Unlike a loan, there is no interest to be paid. Disadvantages: a new business will not be able to use this finance. Many small firms' profits are too small for expansion. Using more profit on the business reduces payments to the owners. Internal source of finance. Obtained from within the business itself. Retained profit, sales of existing assets, sale of inventories to reduce inventory levels, owner's savings. Revenue expenditure. Money spent on day-to-day expenses, example wages or rent, do not involve the purchase of a long-term assets. Capital expenditure. Money spent on fixed assets, example buildings, which will last for more than 1 year. These assets are needed at the start of a business and as it expands. Expanding existing business. Owners of a successful business may wish to expand to increase profits. More fixed assets could be purchased, example buildings and machinery. Another business may be purchased through a takeover, or developing new products to reach new markets. Startup capital. Is finance needed by a new business to pay for essential fixed and current assets before it can begin trading? Starting up a business. When an individual plans to start their own business, they should consider building, land and equipment needed in order to start trading. These are usually called fixed assets, and nearly all new businesses need to purchase some of these. Owner of a firm will also need to obtain finance to purchase other assets, example inventories, before goods can be sold to the first customers. Finance needed to launch a new business is called startup capital. How the choice of finance made in business. Time period, amount needed, size, control, risk. Thank you for listening. Subscribe this channel to remain updated.